risk potential is significantly higher than I think some investors are continuing to put on there to like really understand, and it's unfortunate. So, and the risk reward really isn't there. It's the risk premium isn't there right now. So it's definitely a dangerous time to not be taking all this into account for sure.
That was Jeremy Roll. He's the president of Roll Investment Group. This is Jeremy's second time on the show, and I really love what he brings to the table because he likes to go deep. He likes to go into the numbers and really tell the backstory of what's causing some of the market dynamics right now. Let's get to the show and enjoy it. We'll see you on the other side. The limited partner shares in the potentially outsized returns of a well-planned and executed investment, but as a passive investor, and has the maximum leverage on their most precious asset, their time. And that is why we're here together. 90% of the millionaires out there built their net worth with real estate. However, 0% of the billionaires are hands-on managing the real estate assets because there simply isn't enough time. My name is Jake Wiley, and for the past 16 years, I've been investing in real estate, and I've learned a thing or two. But the most important lesson is how to leverage the expertise and time of others to maximize your investment potential. Welcome to the Limited Partner Podcast. All right, partners, welcome again. This is your host, Jake Wiley. This is an exciting episode for me. I've got Jeremy Roll with me for the second time. Jeremy, I think, really has a firm grasp on what's going on with the market, the economic situation, understands the yield curve is better than I ever could. So I'm really glad to have him back as we are in the recording of this episode is really the beginning of February of 2023 to put a date stamp on it. So for those of you that are listening, in the future, it's a tumultuous time, and I imagine it will be for a while. But Jeremy, welcome to the show.
Oh, thanks again for having me back. I appreciate it.
For those of my listeners out there that don't have the benefit of listening to the first show, one, I think you should go back and listen because it's spot on to where we are today. Would you mind give us a quick background on who you are and how you got to where you are today?
Sure, yeah. And hopefully this will be helpful for the listeners. Thanks for joining us. So my name is Jeremy Roll. I have been a passive cash flow investor, opportunities, mostly in real estate for over 20 years. I've been doing it full-time for over 15 years. The cash flow got me out of the corporate world after I kind of rolled my money from stocks and bonds into cash flow after the dot-com crash. For anyone who remembers that on here, that's back in 2001, 2002. So I'm a full-time passive cash flow investor, been that for a very long time. I also originally from Montreal, Canada, but now I'm in the LA area. I have an MBA from the Wharton School. I did over 10 years of corporate world before I left the corporate world. So I had middle-level management jobs at some great companies. Last two companies, Disney headquarters, and my last one was Toyota headquarters, both in Los Angeles. I also am the co-founder of something called For Investors by Investors, a nonprofit where we try to unite investors in public real estate meetings with absolutely no sales pitch. And I also have an investor group called Roll Investment Group, and that I co-founded back in 2002. So glad to be here.
Thank you for that. And I know I mentioned this before. I think that your transition from a full-time corporate guy into a full-time investor is a dream for a lot of us out there. So love to hear that story. Let's jump into this thing. The market is pretty crazy. A lot of people have no idea what's going to happen. Treasury market, we've got the Fed funds rate, we've got the real estate market. So I think where those two kind of combine. What's your take on where we are today and what's happening with the market? Feel free to dive into some details.
Let's just say that we're recording this in February of 2023. The Fed just announced, I think it was yesterday, in fact, that they were increasing by 25 basis points. Interestingly, on the one hand, they specifically said that they're open to additional rate hikes as in plural, which was not what the market was expecting. On the other hand, I think in some of the discussion after the announcement that he had in the Q&A, that he sounded like he was going to be less inclined to raise rates as far as the stock market's concerned. So we'll have to see. If you take him for his face value and for what he's been saying the whole time, my personal belief is that there's probably a 50% chance he's going to stop hiking rates after the next time and a 50% chance that he'll keep going. And I'm sorry, I'm giving it a 50-50, but the reality is that nobody really knows. But I actually am not saying there's an 80% chance he's only going to hike one more time, which is probably what you would be hearing from the market. So it is a different opinion of a little bit. And I'm just taking that from the fact that if you literally just read what he has said verbatim, his quotes, and then do not read any of the media, any of CNBC, any of the market that wants QE to come back because it's beneficial for them, then there's probably a 50-50 chance truly that he's going to have more than one rate hike going forward. So right now the market has that one more 25 basis point kind of baked into it as far as how it's looking at things. And, it's interesting, the 10-year treasury, actually, the yield went down as a result of the discussion with the expectation that it won't go that much higher. And there's a big expectation they'll pause for a while, then go back down. You can look at all market bet statistics of how far they're expecting it to go down, but That's anyone's guess, obviously. Now, taking that in combination with cap rates for real estate, which is really important, right? So if you're looking at cap rates, or which is the multiple someone is willing to pay on a property. Actually, the true definition of a cap rate is, the actual yield someone's willing to take without any leverage whatsoever, from the net operating income, from the profit. What's interesting is that as an investor myself, one of the main things I'm keeping an eye on is, do I have enough of a spread between the cap rate and the interest rate, say at a 10-year fixed rate loan that the sponsor can get, where I consider to be enough of a risk premium. Historically, you would expect that spread to be somewhere between 125 and 200 basis points. Call it 150 just to be easy. Negative leverage is a little bit of a different definition. I just keep it easy for that. But the point is that there's no risk premium at all in that respect. And what I'm seeing currently is a lot of deals that are still negative, meaning that the interest rate's higher than the cap rate. So I call it negative leverage. But I've seen like as good as maybe 30 to 50 basis points positive, except for unique opportunities. There's a unique opportunity I'm investing in right now. It's a multifamily tax abated opportunity. The spread there, I think, is actually going to work out to roughly about 155 basis points. So that actually tells me, okay, that's a fair spread. Another thing to note is that we've had prices come down. So I'm just going to keep it high level for now and talk about multifamily. We can talk about all different asset classes, but let's talk about multifamily. A lot of investors focus on that these days. Right now, we've seen cap rates change and valuations go down in a lot of markets by 15 to 20% on average. There's always exceptions in all different types of markets. I personally am expecting another 10 to 20% drop from here, just because I still think we have a little bit more interest rate increase to go. And the one wild card that no one's really talking about is quantitative tightening, which directly impacts mortgage rates in some cases. And depending on how much and the extent of what they're doing for it, they ironically could drop interest rates, the Fed funds rate, but do so much quantitative tightening theoretically that the mortgage rates go up higher, even though the rates are going down. So that's something to watch for 2023 as well. What's the quantitative tightening situation looking like?
Will you explain that a little bit? What quantitative tightening?
Yeah, so quantitative tightening is basically the opposite of quantitative easing. So I feel like if I say that, then maybe some people more easily understand. So quantitative easing is when the Fed is buying assets, and it's doing so to provide more liquidity into the market and to keep money flowing, so that if somebody originates a loan, the Fed may buy it. That person can recirculate the money, originate another loan, and now they can originate two loans instead of maybe one that they would have had held on to because the Fed bought it. And what's really unusual when we go back to 2008 and 9 is that it started buying mortgage-backed securities back then. I believe that's when they started. Hopefully I'm right about that. But anyway, so now you have the Fed owning treasuries, you have the Fed owning mortgage-backed securities. What happens when the Fed buys mortgage-backed securities? It's an artificial buyer in the market that wouldn't have been there otherwise. When there's more demand for an asset, the price goes up and the yield goes down. That's the inversion, that's a relationship for a bond, right? And so if the Fed steps away and starts selling the mortgage-backed securities, which is actually what it's doing, that's quantitative tightening. It's the opposite effect. You have less demand and more supply. And by definition, therefore, you technically would have to have a higher yield for it to be more attractive for the next buyer to buy it. And that's where you could potentially have the Fed unwinding some of its mortgage-backed securities and having interest rates go up, even if interest rates on the Fed funds rate or treasuries even just remain flat.
Yeah, and I was just kind of articulating that sometimes an inverse relationship, people expect rates, if the Fed raises rates, the mortgage rates go up. And that doesn't always happen. And the inverse also happens as well. And that's because of what's happening on the secondary market, of whether, exactly what you're talking about, are they buying or are they not buying? And there are trends, and we're trying to share information here. And I think that's a really good trend that I do want people looking at.
Yeah, and it's another thing to actually point out about this is very important is that, so the Fed actually raised the federal funds rate this week, but the 10-year treasury went down. And the reason is because theoretically the market is supposed to be forward thinking. And it is, right? And so it's already thought ahead to the fact that if the Fed hasn't really said much about raising multiple more times and is expecting rates to come down eventually, it's already thinking ahead. But the opposite remains true as well. So for example, if the Fed is doing quantitative tightening and they're expected to do a lot more of it, what's going to happen is that the rates are going to go up much more quickly than what they're selling, because the people who are currently buying those assets are saying, I need a higher and higher yield to be able to compensate for the loss in value that's about to occur as the Fed sells more and more of its assets and the price continues to go down. They're going to front run that or think ahead to protect themselves. It's a very important point, Jake, that you can't expect a perfect correlation, but it is more forward thinking.
Yeah, thank you for that. Maybe thinking, again, some other interesting trends. As you watch the news, you see like office space is just taking a beating. in the marketplace. So much so that like we're really starting to see, folks basically just handing the keys back to lenders. And, that's a lot of that has to do with debt refinancing and, terms coming due. And it's the same thing's going to happen in multifamily. It's going to happen in all the asset classes. And you've already mentioned that you see values coming down 10, 20%, maybe another 15%. I might have to come back to your numbers again. But like, this is a significant change in some of the valuations. Do you see, one, what do you see there more specifically? And then two, like the way I always like to look at these things is like, where's the opportunity? Because there is opportunity coming.
Yeah, great question. So first thing I'll say is I think one thing for people to keep in mind is that it's not always just a refinance event that will cause someone to hand the keys back, although that's clearly a possibility. You have to keep in mind some of the requirements of some loans and a debt coverage ratio. So the first thing coming to mind to me, what you were saying is not necessarily that the office space is handing the keys back and waiting until the loan's coming due to hand the keys back. They're potentially breaching a debt coverage ratio far before that happens, right? Depending on the status of their building. I want to point that out to people because it's not just about when the loans are coming due and you can just look up all those statistics and figure out what may happen. The event of a default can happen much sooner than that. Now, one of the things I'm anticipating is that, and this happened during the previous downturn, is that I think that especially the CMBS lenders are going to become so overwhelmed with properties, and it's not in their best interest to necessarily take properties back and write them down immediately, that they're going to not necessarily kick the can down their own, but going to stretch it out. There's a difference because they're not going to delay it, but they are going to go slowly, and they're going to have to take some properties back, but they only have so much bandwidth to do so, and they only have so much interest to do it at a certain pace. So I'm expecting that will happen. I fully agree with you. Multifamily, the dominoes are slowly falling, and it's a real shame. But so I have not personally invested in any floating rate loans in the past few years, with one exception of a senior housing facility that's very unique. So it's like not even worth discussing. And the bottom line is that I've been hearing from investors who did a lot of investing the last 2-3 years and are now not getting any distributions at all. And that might be, let's say, their best case scenario, and hopefully the property will make it through. But my concern about that is that I think a lot of people invested in multifamily the last 2-3 years. It was by far the most popular asset class I heard about, right? And I was steering clear of those types of deals. But my concern is that I think there's a large percentage of investors out there who are willing to deploy capital on the non-institutional side, who are possibly going to sideline themselves purposefully, waiting to see what happens with those apartments and kind of souring a little bit on the whole limited partner role until that gets sorted to see what happens, some of which may foreclose, some of which may not. And I think that sponsors are about to have a hell of a time compared to now. In the next probably 6 to 12 months, going to have a much harder time raising capital. I think that should not be understated. And if there happens to be a recession at the same time, and all of a sudden you're knocking out a few more people that'd be willing to deploy normally without that concern, now you've got a smaller capital pool base on the equity side. So I think we're about to enter a very challenging period. I think it's interesting because one way you can always tell this is the $25,000 minimum. I tell you that I don't think since 2012 that I've seen a $25,000 minimum in a normal deal, because it was easier to raise capital. We were behind us on the downturn, and 25,000 I could find in the previous cycle from 02 to 07 when I invested. But once we had the end of the downturn and there was a lot of capital coming to be, because it was already doing actually a lot of quantitative easing back then, that kind of went away. There's now 2 times I've seen it since then. The beginning of the pandemic, for the first 2 months before quantitative easing was announced, all the stimulus, sorry, not the quantitative, the stimulus, sponsors who were under contract that were desperate to raise funds and had a lot of trouble immediately went down 25,000, and some very experienced sponsors. So that was an obvious sign they were having distress raising capital. It's happening now again. I just saw one very large sponsor who kind of ran an email and said, for a limited time, you can invest in our fund at 25,000 for the next 2 weeks. And my instinct, my personal guess, it's a full assumption, could be completely wrong, is that they're probably trying to close on a property within that fund, probably already gone hot on it and not quite fundraised all of it, and allowing people to go into the fund and use that capital towards that property. Total guess. But I don't see another reason to be doing that, right? Because it makes life harder for sponsors to take half the minimum they were before. I think that's become a very big factor going forward. And I think that's actually going to sideline some sponsors who won't be able to raise the capital they need to. So that's another factor coming into play on the demand side of things, not the supply side of properties. One more thing we could talk about is the supply side of properties. Very sparse right now, especially on the multifamily side. It's only people who have to sell that are selling. But what I'm also seeing is some people with performing properties, which also happened in the last downturn, selling off performing assets to cover distress in non-performing assets, even if not from the same asset class. There's a 2-property portfolio I'm investing in right now, multifamily. One I mentioned, it was tax abated, and both of those properties were purchased from distressed funds who either have redemption calls that they have to kind of make, and they're selling off their performing assets to do so. That was one case. And the other case was somebody was selling one multifamily property to deal with the distress of another multifamily property. And that actually, when you ask about some of the opportunity, that's where it's starting to come from. My concern is that unless you're getting a highly unique pricing and deal right now, real estate moves slowly. We're just starting to see the prices adjust the past few months. It typically takes 18 to 24 months to really see major, like full adjustments. And unless you're protecting yourself by getting very unique deals or unique price reductions from current market, not from the peak, I think you're still at risk of catching a falling knife, and that asset could be worth less in 12 months. There's opportunities. I'm not saying not to take them, but just be particularly picky about your pricing, basically.
Yeah, that's a great point. I mean, we've talked about that, and I've talked about that in the blog, the catching the falling knife, right? Like in this price discovery market that we're in, is that people are waiting, right? And nobody wants to be the one that's catching it right at the top of the curve, right? Still got a ways to go. And I appreciate your points on the tightening of the capital market itself, right? For non-institutional investors. That's a really great point that I hadn't thought of. So thank you for that. But I do want to emphasize that point you made that there will be opportunity. So it's not like, don't just close your eyes and, wait 2 years, right? I think you got to be very selective of the deals that you're looking at, but I would still look at them, right? Because this is my projection. My prediction too is that there will be deals similar to the ones that you've seen where, investors want to handle something quickly and quietly, and they will take a little bit of a beating to get it done without it becoming like a big public to-do. So there might be, in some cases, a sense of urgency on some of these deals. Wouldn't dismiss it just because there's a sense of urgency. There may be, hey, we're trying to take care of this quickly and quietly so that, we can catch this opportunity.
Yeah. I want to address one more thing. It's a separate topic if it's okay, but I think a lot of people are saying, look, the economy seems fine. GDP still looks good. Consumers appear to be spending, et cetera. I don't necessarily disagree, but if I could just give an opinion, which could be completely wrong, about why we are where we are today and why I think we're going to be in a very different place in 3 to 6 months. And I think you're starting to see a lot of people in the media talk about that timeline. There was, I think, about 3 trillion excess savings that came of all the stimulus money at the peak. Okay. I think that peak was in 21. So consumers have now dwindled down from those 3 trillion in savings to between 1 and 1.25 or so trillion in savings left. And that is going down every week, obviously. And there are some consumers who are already tapped out. The ones who spent more heavily are now done. And some of them who saved a little bit more are just getting through it. I think that what you've seen here in the last couple of quarters is excess of trillions of dollars of stimulus money that was available to people still, that I think a lot of people don't really realize is still out there. I think that once that entire safety net is gone, which is projected to happen in the next 3 to 6 months, now you've got a problem, because we've already got a problem of people who are already through theirs. Now you've got the rest of the people through theirs, and you have companies laying off, expectation of the economy slowing down, is all happening at the exact same time. And so I think that this recession is taking a long time to unfold itself because of that stimulus money. And I think that stimulus money is going to be gone in short order. And the reason why I mention all this is because I have 2 concerns about pricing right now. One is the effect of the cap rates adjusting and people paying a lower multiple. And that's still, I think, unwinding. The other, though, and I've been saying this for a long time now, is I'm expecting in some properties, depending on the location and asset type, flat rents or negative rents in some cases, but you have very strong inflation still, right? And that is a definition of stagflation. But what that also causes is a property in January compared to it that 12 months later in December, the NOI is lower at the end of the year than the beginning of the year, because you've had revenues not go up, but you've had expenses go up pretty significantly. So all of a sudden, the property you bought in January, even if the multiple held constant, it's actually worth less. So you have a compounded potential effect of property prices decreasing still. And I think whoever hasn't thought about that, is very important to contemplate, because even if you believe that interest rates aren't going up much more, and if you believe that cap rates are going to go flat for a while, that is a very real risk for the end of the year and beyond, as far as the value of an asset you may be looking to invest in today. And the compounded effect really worries me, because I think they're both going to play out.
Yeah, I think those are really great points. And you're right. Like if revenues flatten or even go down a little bit, but costs keep going up, like labor shortage, like that's a real risk. And that's not going to be projected. And I don't think anybody expects that unless you're really thinking about it.
I don't mean to throw Ken McElroy under the bus. The only reason why I noticed is I watch a lot of his videos on YouTube. He has a great YouTube channel. In the middle of one of his videos, it was like a little piece of it about 2023. He talked about his budgeting for his multifamily properties. For those of you who are not familiar with him, he's an institutional investor, owns, I think, $1 to $2 billion of multifamily, very smart guy. He said he is budgeting, at that time, he was budgeting in like November for his 2023 property budgets, 0% increases in revenue, 7% increase in expenses. Okay. That is a huge change, right? Because you compound that on a cap rate that might be going up slightly, and all of a sudden you've got a very significant change in the property value alone, right? So it's not just me that's saying this. He's concerned about it specifically, and he's budgeted for it. So don't just take my word for it, but I think it's a very big risk for this year.
Let's flip over to some opportunities. Let's bring some light to this. Last time we talked, you were looking at kind of short-term opportunities, getting out some like hard money lending, investing in ATMs, assets that can fully depreciate. I think that's a really cool strategy. I'm looking at some interesting stuff myself. But what are you doing now? Same strategy, or are you pivoting?
Great question. So last time I had three buckets that I was considering, and that included the short-term investments just to keep some money working while I wait to see what happens with asset prices. That third bucket is now gone. That actually third bucket left probably towards spring or summer of last year. I have two buckets I'm considering right now. One is, which are the other two buckets I was considering before. One is very unique opportunities where there's so much cushion in the asset price and I'm comfortable continuing to move forward, like that tax abated example on the multifamily side, even though I wouldn't go near a market rate multifamily deal yet myself, unless there's that spread, but I'm not seeing it. And then the other is unique opportunities where I don't have to worry about the asset prices decreasing, which is my primary concern right now, that I think will do well during a recession. So I'll just give a quick example on the ATM side. I've been investing in ATMs since 2008, so I'm very familiar with the asset class. And you're basically investing in assets that are literally a computer, right? So it's screen, a bill feeder, a computer, keypad, and it's basically computer equipment that's depreciating almost to zero. Do I care if it's worth a little less, more than I thought at the end of this year? No, because it's a 7-year useful life, just making that up, and it's going to be worth 3 to 5% at the end. So I don't really care what it's worth tomorrow. I care about whether that cash flow and that revenue is going to continue during a recession. In my experience in 2008, I'd already been investing in some ATMs. Revenues dropped about 15% in my portfolio in the last downturn, but there's so much margin that really didn't cause a problem, especially in terms of the investor preference versus the sponsor split. So I'm pretty confident probably be a somewhat safe investment for myself. So that is something I'll continue to invest in now. If I think it's going to do well during a recession, I don't have to worry about the asset price decreasing. But obviously very hard to find a situation where you're not going to worry about the asset price decreasing.
Okay. So third bucket is out.
Because what I was doing before is a great example was hard money lending. I was lending to flippers. Literally, the minute the first interest rate increase happened, I stopped lending and I exited the rest of my loans within 3 to 4 months. And that was it, because I had a bad feeling that obviously with interest rates going up, asset prices are going to come down. So a lot of those short-term deals rely on lending against assets, but the problem is you're lending against an asset that may be going down in price. So that's why that bucket is no longer valid.
All right. So I guess what else should we be looking for in terms of opportunities in the market? I'm going to go back to the office because I think that the office issue could have a massive impact on the real estate market, meaning that if 40% offices are 40% occupied, housing, office stock that's older than 1980 is effectively obsolete at this point. Nobody wants to move into those. Those are going to start coming out. Like they're going to start dying and nobody wants them. And I've had several conversations where people have told me that if for those assets that they own, there's no amount of money or no opportunity out there for them to repurpose them into something else and hit the market.
Yeah. So that's actually what I was going to say. Some people are looking at those types of assets. And what comes more to mind is the more typical thing I'm seeing people consider is a conversion of a retail strip center in an infill area to apartments, or a conversion of a retail strip center in a retail area to self-storage. But it all depends on the cost basis. So if you can get a retail strip center that is highly distressed, that's 30 or 20 or 40% occupied, and you're buying it, almost at land cost at that point. I'll also warn you though, that if you buy that type of property right now, theoretically land cost goes down significantly, very volatile, one of the most volatile things in a downturn, right? So you got to be very careful that you're thinking ahead on that as well. But I think the office play is very challenging because often office is multi-stories, more costly to tear it down, harder to repurpose. Some people have repurposed office buildings, depending on how built, into like hotels before. That's not something I'm very familiar with. Hotels are picking up again, but if you have a recession, they're going to go down again. So it's a good thought, but I think there's two challenges with it. One is, are you catching the asset at the right price? And two, is it economically feasible to go through that entire exercise, and does it really make sense? And by the way, are you really getting a good spread for it? Not just for the risk premium, but also because of the potential risk of a recession and you having to deal with all that. And another thing we haven't even talked about is availability of credit be able to do that project. The lending markets are very tight right now. And I don't do any development or major redevelopment stuff. I've never been in any of that. So I can't comment on it, but I can only imagine it's very challenging to get lending for that right now. And I'm guessing that the easier stuff to get is probably going to be bridge lending, which is still very difficult to get right now. It's going to be very expensive and make those projects not feasible.
Yeah, and I'm actually more concerned of it being like a spiral of death, right? Meaning that, let's say you've got an office building, somebody bought it, it was a B minus, C plus office building 3 years ago, and now it's effectively worthless, right? That's the reality of the market. So who ends up with that? The bank. The bank's got it. And the bank is going to have to discount it to sell it just to get it off the balance sheet because they are not in the business of owning real estate. Who is then going to turn around and finance the redevelopment of those assets?
It depends on the bank and depends on the scenario, but a lot of people had some success on the last downturn getting that exact bank to finance it. And in some cases, literally, they would just say, pay me nothing and I'll finance it. No money down and I'll finance it, just because they're desperate to get that stuff off their books because they're not in the business of holding assets, especially not depreciating assets. So that's actually a possibility. I've seen those types of deals happen pretty frequently in the past. It all depends on how bad it gets, how desperate they are, which bank it is, how many assets they're holding. That'll run obviously a whole spectrum. Like the lending piece is going to be the big hurdle. And frankly, I think that the banks know that if they have that asset and you can't get lending on it to reposition it, they may be the only lender available for you to do that. They may have no choice.
Yeah, I think that's going to be fascinating to watch unfold. It's probably a 24-month unfolding, right? As these things kind of unpack themselves and covenants are blown, and to your point, things get stretched out a little bit. They slow the process to try and not make it so sharp, but like it's coming.
I'll tell you what I think is going to happen sooner than that, which is I think that on the multifamily side, I think that some of the bridge loans, if those lenders can't afford to just kick the can on their loans, they may have to take some short sales. And I haven't seen a short sale yet, but I do expect them to start happening this year, potentially, maybe second half of the year. We'll have to see what that looks like and what kind of pricing they offer. I think that some lenders will be in much more distress than others. So it's really going to depend on their situation.
Yeah, I think, unfortunately, nobody has a crystal ball and we can tell exactly what's coming here, but there will be some changes. There's no doubt about it. And there will be some value drops.
Yeah. I hate to say this, it's very, stereotypical, but patience pays off in this case. And it's really true. And the good news is that this isn't a question of patience waiting 3 years. This is like, wait a few more months and you're going to be in a really interesting position. I actually have the exact same opinion about the auto market if you're buying a car, new or used. That's a whole other discussion. That's it's a huge subprime problem right now. There's record high 90-day plus subprime delinquencies in auto loans that people aren't aware of. And so far the lenders are refusing to dispose of their assets. They're just repossessing them and then they're not letting them go. They're trying to put them through the auctions. They're not getting the reserve and they just keep going every week when they take the markdown yet. So that's another thing that'll be interesting to watch. But the total capitalization, total size is not so significant that it's going to cause a huge disruption in the capital markets, most likely. But that'll be interesting to watch too.
Yeah, I don't know what it is, but for some reason, the automotive industry for me seems to be like a tangible sense of normalcy, right? Like when you watch that, and I don't mean that like it's going to fall apart, but I think once that stabilizes, I watch it, right? Like I watch it because I think that there's a lot there that's like foreshadowing what's to come.
Yeah, and that's a whole other mess. I mean, it's literally rinse and repeat of what happened on the housing side in 2008. They were lending subprime borrowers up to 150 to 160% of the value of the vehicle. Now people can't afford to pay it. They were allowing people to use stimulus checks to be able to make the payments or justify that they had the income to make the payments when they really didn't, and now they can't afford them anymore. That's a whole stimulus piece we just talked about where that runway is running out for people. A lot of cars are getting repossessed right now. It's a bloodbath at the moment. It's not obvious if you look at vehicle prices yet because they're not allowing all that supply to leak out quickly enough. But at some point, they're going to have to let more of it leak out, most likely. And, the prices are already falling, but I think we'll see it much worse.
I mean, I think that these are great insights, things to watch. There's trends. And that's really what I want for this community, too, is to see kind of what's happening in the background that's really going to make an impact. Because like if you talk to a sponsor today, they may tell you everything's still great, right? And they've got a great performance and everything's happening. But there are subtle things happening. And there's some very not subtle things that are happening as well. All those things are really important to kind of make a decision of where you feel comfortable. Because a lot of, the community out there, you guys have worked really hard to build this nest egg of money that you can invest. And you got to be careful where you put it. And I think that right now, more than, in the past decade plus, it's a time to be very thoughtful.
Yeah, and it's unbelievable to me that, if you're an investor right now, just really understand the debt terms and the structure of the deal and the timeline and what the risks are if you can, as best as you can. I've seen a lot of deals close in November, December, January so far that had more floating rate loans with similar risks to the previous floating rate loans. I think the risk potential is significantly higher than I think some investors are continuing to put on there to like really understand. And it's unfortunate. So, and the risk reward really isn't there. It's the risk premium isn't there right now. So it's definitely a dangerous time to not be taking all this into account for sure.
Jeremy, this has been another great show. I really appreciate you being on here. Is there anything else you think you want to share that would make this episode complete?
I hope this is for this investors. Actually, I'm really happy you have these types of podcasts, Jake, because it's just so critical to stay on top of the data to be able to understand what the pitfalls may be in 6 to 12 months, because it's not about what's happening now. It's about what could be happening in 6, 12 months at the moment. That's what we're both, and a lot of people are worried about. If you see a deal and it looks like a great marketing piece and you're like, oh, this looks fantastic, take a step back, make sure that you're thinking about where could that be in 6, 12, 18, 24 months from a recession standpoint, from a valuation standpoint, from a rent growth standpoint, from an expense increase standpoint, all kinds of stuff that I would ask the sponsor and think about yourself before you jump in at this point.
Yeah, and I'll echo that. I think that, as we think about what do you really want out of these deals, a lot of it's the passive income, right? And you mentioned at the beginning that you're starting to see investors really talk about that they're not getting distributions. And that's the best case scenario, right? Like, heaven forbid, there's like a capital call to try and keep this thing afloat and it's going the other way. But it's really important that you know what you're trying to achieve. And then to your point, sometimes it's just best sitting on it. Being patient is really the best investment. So thank you for that.
Yeah, no problem. Well, thanks again for having me on. I appreciate it.
Awesome. I hope you've enjoyed today's episode, and I'd actually love for you to contribute to a future episode. If you have a question you'd like answered or a topic or a guest to bring on the show, please email me at jake@thelimitedpartner.com. Now I realize there's a lot of lingo that's thrown around on these shows, so I've created a cheat sheet for you with the top 26 terms that come up most often. Head on over to thelimitedpartner.com/lingo for the list. Enjoy, and we'll see you next time.